What's going on, everyone? Welcome back to the channel. Today's video is going to be about the IPDA market cycles. The IPDA stands for the Interbank Price Delivery Algorithm. The IPDA market cycle are also known as the phases of price delivery, and this lesson is going to be an important lesson because we will need these phases of price delivery in the next lessons. So the IPDA market cycles are very important in trading. These cycles actually represent the price movement. The price is always transitioning through one of these phases: consolidation, reversal, expansion, and retracement. Here you can see in this schematic, we have a consolidation followed by a reversal, an expansion followed by retracement, another expansion, then a consolidation followed by a reversal, then consolidation, then a retracement into fair value gap, and then expansion. So price will always go through these phases of price delivery, and we will cover each one of them in detail. The first one is the consolidations. Consolidation actually occur when the price is building low resistance liquidity run or failure swings on both sides of the market. Actually, consolidation is a defined range, like you can see it right here. Price is ranging between that range high and the range low. It lacks that expansion moves, that big candles. When the consolidation is gonna occur, when the price is shifting trend, like when the reversal is occurring, the consolidation will occur prior to that. After a previous large expansion, the price will consolidate. You have heard this saying, large ranges lead to small ranges and small ranges lead to large ranges. When there is a high impact news ahead in the week, the price will tend to consolidate. And a consolidation ends with a manipulation to the one side, and then expansion taking those low resistance liquidity runs and then expanding in the direction. The next phase of price delivery is expansion. Expansion phase is the phase which we are benefiting from. During expansion phase, the price is printing large candles. Like you can see it in this schematic, we had a reversal, then the price is expanding in a single direction. The expansion is occurring after a consolidation followed by that range manipulation. The expansion can also occur after a reversal. When the price is reversing, the other side of the reversal will be an expansion. Maximum expectations for the expansion is 3 candles. Like this is the historical behavior of price action. The price will expand for 3 candles. Then it should change the phase of price delivery, transition into consolidation or retracement. Now the third phase of price delivery is retracement. A retracement phase actually occur within the expansion phase when prices temporarily move against the prevailing trend. Like in this schematic, you can see we had a reversal followed by a 3 candles expansion, a consolidation, a retracement into this fair value gap, and then that is the move opposite to the original trend, which was upwards. Then we tapped into this fair value gap followed by another expansion. So the retracement is temporarily that move against the trend. The key characteristics of expansion are: retracement happen after an expansion, expansion, retracement, expansion. And the PDRAs we will be using are the fair value gaps and the order blocks. Now the next phase of price delivery at that reversal. A reversal happened when expansion meets another expansion. Like here you can see we expanded to the downside, meet a point of interest, and then expanded in another direction. That is indicating that reversal followed by a change in state of delivery. The reversal are the important phase of price delivery we will need, because transition in a high time frame phase of price delivery will lead to reversal on the lower time frames. Like for example, a higher time frame, a daily time frame retracement will lead to a lower time frame change in the state of delivery. A higher time frame leaving consolidation range will lead to a change in the state of delivery and reversal on the lower time frames. So the reversal phase is the most important one, because every phase of price delivery followed that reversal signature on the lower aligned time frame. Now here we are on the gold daily chart. We will go over how the price transitions through the phase of price delivery, and then we will go through the examples in detail. So here in the first example, we are consolidating between the range high and the range low. So a range bound price section. Prior to that, you can see here was a big candle. So large ranges lead to smaller ranges. Now here at this specific point, we have SMT divergence with silver. So The silver manipulated the range low, and the gold is creating that SMT divergence. So we are expanding from this point onward, and also we are closing above the down close candles, and we will talk about this in the order flow lesson. I will be going over all the PDA rays and all the variables you have to define in order flow. So here we have manipulated the range low, expanded through. Now after 3 days of expansion, we meet a high, and now we are likely to go to the downside. So here we can see there was that reversal signature, expansion meets expansion, and every further price delivery will be a reversal on the lower time frames. And we kept expanding, and here we have created SMT divergence with silver again. You can check that out later. Now we are closing above the inversion fair value gap. We will talk about this in the order flow lesson. So here we have that reversal with SMT divergence, followed by these candles, now a consolidation, followed by manipulation, and then another expansion. Now here we have created this swing point inside this volume imbalance, and also these down close candles are supporting the price action, so that will be another expansion. Now after expansion, we can predict another price, which will be retracement, because we have not met a point of interest for a reversal. So here we have created that swing point and then expanded away. And here you can see the signature. We are closing above the down close candles. Now here we retrace into this fair value gap. So this was retracement, expansion, retracement into another expansion. Now we have retraced into this down close candle and another expansion. Now we have taken some lows and created that swing point, expansion, consolidation, manipulation, then another expansion. So here we are with our first example. We are on the NQ 4-hour chart, and we are consolidating between the range high and the range low. The consolidation is when the market is building low resistance liquidity run on both sides. So we have failure swing above us right here, and we have failure swing to the downside. We came here but didn't took that low. Now we need a manipulation of either consolidation range high or the consolidation range low to trade it to the other direction. So here with this candle, we have manipulated the range high and we have closed inside strongly. So this is suggesting us that the price is gonna go to the downside because the range high is manipulated. And now, as I have told you, transition in each feather price delivery will lead to the reversal signature on the aligned time frame. So here we have the candle 2 closure after the consolidation range high is being taken. Now we can drop down to the aligned time frame to look for that reversal signature. So this is 4-hour. I will drop down to the 15-minute chart. So here on the 15-minute chart, you can see this was that consolidation range high. We have manipulated that, and here we have that reversal signature, expansion to the upside followed by another expansion. So the strong candles to the upside and then followed by strong candles to the downside. And also you can see we have a change in state of delivery, confirming that that consolidation range high is taken, and now the price is expanding to the downside. So change in state of delivery for another confirmation, and now we can enter right here, stop above the body highs, and now we can target the range low or just stick with the 2R. After manipulating the consolidation range high, which was right here, now we can expect another feather price delivery because we have a large expansion. So that phase could be a retracement because it is the historical nature of price action. We are in a downtrend, so we would be probably retracing. So for the retracement, we have down close candles and the fair value gap. So this fair value gap isn't confirmed yet. Now with this candle closure, this fair value gap is now confirmed. We can retrace into that and then trade that retracement into expansion. Now we have traded into that fair value gap. We need that swing point formation inside that fair value gap to then trade it to the downside. Now after this candle has been penetrated inside that fair value gap, we reacted off of that. Now the retracement will also follow that reversal signature on the aligned time frame. This is the daily time frame, so we would drop down to the 1 hour time frame. And here you can see that retracement into expansion is also following that reversal signature, a change in state of delivery followed by expansion to the downside. Now in the last we have reversal. Reversal is the price space when expansion meets expansion. Reversal can occur just like that. We are at all-time highs. Expansion meets expansion and that reversal signature. Change in state of delivery confirming that to the downside. Or another way reversal can happen like that. Like we have reached into these highs, a consolidation, then followed by a manipulation and then expansion to the downside. So reversal can occur above all highs or all lows by both ways, consolidation into expansion or expansion into expansion. And catching reversal always need that candle 2 confirmation. So here we are at all-time highs. We have a candle 2 closure inside the range and we are likely to disrespect this fair value gap. We will draw that out. Now on the aligned time frame, we need the change in the state of delivery to confirm that reversal, and then we can trade the continuation to the downside. Now on the hourly time frame, we are disrespecting these fair value gaps on the left side of the curve or buy side of the curve, and also we are not reacting off of the daily bullish fair value gap, and we are using that as an inversion fair value gap. So my bias would be bearish. We have a change in the state of delivery right here. Now with the next step, we need a closure below these up close candles to confirm the order block. Now here we have another series of up close candles and a closure below it. And this is how we expand it to the downside of these order blocks. Now catching reversal is not favorable. All you can do is wait for that candle to closure, and then you can trade the third candle as an expansion candle. In the next video, we will talk about the internal to external and external to internal range liquidity. And then after that, there will be a daily bias video. And then in the last, we will combine that into a model. So thank you guys for watching. Make sure to subscribe to the channel and like the video, and see you in the next one.